What happens when everything we think is absolutely true isn't? I've been thinking a lot about the conversation we've been having in real estate around office buildings, around the death of office buildings, how we're going to have to tear them down, or we're going to have to turn them into apartment buildings or vertical farms, or else these buildings are just no longer usable. But what if we've overstated? What if, as we look at 2025, we may need more offices in more places? What happens then?
You are listening to the AFIRE podcast, real estate, technology, cross-border investing, and the opportunities of a changing world. Let's start a conversation now.
I'm sitting today here with Melissa Román Burch. Of course, she's the Chief Operating Officer of New York City's Economic Development Corporation and a frequent speaker at AFIRE. We are asking a lot of people around surprises in 2025, and I wonder, are we going to see anything that perhaps goes counter to conventional wisdom, especially around the office market in New York City? What do you think, Melissa?
Gunnar, I think we will. And thank you for inviting me to be in this conversation. Yes, the office is making a comeback. We fundamentally do not have enough Class A and A+ office space in New York City, and we have too much Class B and C. So what we are going to see really unlock for New York City in 2025 is continued investment into modernizing office space and delivering new. We need to do this because we know that New York City will continue to be powered by a very strong economy, excellent job growth, and we also know that we will continue to be a global center for work. So what we need is office investment in New York City, and I think that all of the stars have aligned to make that true in 2025.
Wait a minute. We have spent the last couple of years talking about the death of office and how we need to tear it all down or turn it into apartment buildings. But what you're saying is you're running out of office space in New York City. Am I being too exaggerated by saying that? I mean, is that really true?
Yes, it is true that we are running out of high quality and the best office space within New York City. And what we know is that there's a great resorting of office space that has happened since COVID. Mm-hmm. We've seen the sorting into the haves and the have-nots, and what's underpinning that is green buildings versus brown buildings, buildings that are leaning into sustainability and being on the cutting edge of, environmental quality, not only for the occupants, but in terms of decarbonization. We're also seeing a great resorting in buildings that are, I'm going to call them connected versus commodity. By a connected building, what I mean are buildings that actually do something for employees and are transformative for employers that are looking to drive their businesses forward. I think that we all know that it is true that you can work from anywhere. Mm-hmm. But the point of working from an office is that you can work in a way more connected fashion with your coworkers, with your clients, and office space needs to deliver on the promise of what can you only do in the office, and what can you only do in the office is really drive connection. So we're going to be seeing that as an underlying theme of why we are running out of office space, is that we are running out of the best office spaces that really underpin the haves, the move to green buildings, and the move to connected office buildings that are in really strong markets that drive social districts. So people don't want to just live in a residential district and work in a business district. They actually want to be embedded in a social district where there can be a live, work, play, entertain, learn component to their everyday lives.
And it seems to me that New York City, more than perhaps any other city in the United States, is built for that. It's always been a live, work, play environment, not just in Manhattan either, but in a lot of the boroughs. So you're well positioned for that transformation from a single-purpose CBD to a multi-purpose environment, correct?
That is exactly right. That's exactly right. And what will surprise us about this in 2025 is exactly your point about, wait, don't we have an oversupply of office? What about hybrid work? Hybrid work has been baked in, and the demand for the best buildings continues to rise. Mm-hmm. That is the surprise of 2025. And when you forecast and look out ahead, of the 2.4 million square feet of office space in New York under construction today that will be delivered by 2026, almost 80% of that is already spoken for. So if you are not already proactively dealing with your office needs as an employer, as you sort of look ahead into the next couple of years in terms of office expirations, you're going to get locked out of the market. I think that will be surprising to people. And as people sort of lift their heads up, come back up and scan the market saying, where do I want to invest in my employees and where do I want to invest in new workspaces? Their options are too limited. And New York City's done a lot to make sure that we can be partners with investors that want to make those significant investments. The first is our MCORE program. This is the Manhattan Commercial Revitalization Program. It is a tax abatement program that was announced about 18 months ago. We have 2 buildings in New York City that have already been voted on by our board and by the Industrial Development Authority Board for tax benefits. That's 850 3rd and 175 Water Street. Those projects are undergoing transformational modernization of existing assets to take them from effectively a Class B building to a Class A plus building. So we are providing tools to the marketplace. We're not saying just do it on your own. We're saying we can be partners with you in helping to bridge to the future. And, it's a big check to take a Class B office and bring it up to the highest standards of environmental performance, of, office amenities, of, delivering on the promise of a connected building for, the knowledge worker. So we know that takes a lot of investment and we have programs to help people get there.
Certainly nothing lowers the risk more than having somewhere on that block a building that is succeeding to do that is driving even more interest in that area and proving out the thesis that, a B or a C class office building with particular kinds of investments can become that desirable asset, that asset that everyone wants, and that neighborhood can become a desirable asset. I mean, to a certain extent, there are parts of Manhattan that never dropped, that they were always a Class A area, and no one had any doubts about, One Vanderbilt being a successful building before it was even completed because of where it was right on top of Grand Central Station. I think it's going deeper into some of those other neighborhoods that aren't as obvious. And it sounds like you are making steps to make sure those less obvious areas become obvious, even for the most risk-averse investor.
That's exactly right, Gunnar. And, this is driven by data. So one of the things that we've been able to benefit from is Placer AI data that looks at phone data. And the Real Estate Board of New York has now been tracking over a series of years the visitation metrics of people visiting office spaces. So this is not just employee key card swipes. This is actual visitation, meaning not only for employees, but people hosting meetings, people having conferences, people doing networking with clients. That gets captured in a broader view of looking at office visitation. How well are offices being utilized? Well, what we see is in the best office buildings, in the A and A plus buildings, that the office utilization is significantly higher than B and C class buildings. We're also seeing that within neighborhoods within New York City, that we're seeing higher utilization of offices in Midtown versus downtown.
Right.
And I think that, interestingly enough, too, when you look at the 2023 numbers versus the 2024 numbers, 2024 is improving in all of those categories significantly over 23. So you're just seeing, a trajectory in the right direction, which is that people continue to come back. This trend has not worn through. It's not that, all of the people that are coming back are back. No, we're seeing that these numbers continue to improve. And when you look at those best buildings, we're at 85% of pre-COVID levels in terms of office visitation in trophy buildings. So that's really highlighting versus something in the mid 60s for B and C buildings, just how profound this trend is and how the data really proves it out.
I think part of what's interesting here is that in some ways, we have been limited by the data that we're looking at, that it's not giving us a complete enough picture. I mean, thank goodness we had the Castle data, especially at the beginning of COVID, so that we could track things, but it's a very blunt instrument. And it seems to me that, and you've talked a little bit about Placer data at AFIRE before and how it tells a different story about the city. I hope that other cities, embrace these other data sources as well, because it's very granular. It seems to me something we can act on, that we can actually invest into a little bit better than just saying, we're 50 or 60% of where we were in terms of office utilization, which is not really true because office utilization has changed. We use it in a different way than we did maybe in 1965. It has evolved. So I'm really excited that you're bringing that kind of data to the forefront of the conversation. It seems to be changing the conversation, and maybe it surprises some people when they first start looking at that data.
That's exactly right, Gunnar. And I think that we can only make as good investment decisions as the data enables us to sort of understand what is truly happening. The cell phone data has really opened up new ways for us to understand how people are moving through the city. And this is not only useful data for understanding how offices are being utilized, but is also really critical when looking at retail, when looking at streets, how are streets being used, how are people moving through the city. So I think that's fundamentally what we're trying to understand through this data is how are people moving through the city and utilizing the built environment.
Fantastic. So I'm prepared in 2025 then to be surprised by office, to be surprised by cities and their revitalization and understanding them better than perhaps we ever did before. We've been speaking with Melissa Román Burch, COO of NYC's EDC, Economic Development Corporation. Thank you, Melissa, so much for giving us your perspectives on 2025.
Thank you for having me, Gunnar.
You've been listening to the AFIRE podcast. Remember to subscribe on your favorite podcast subscription service, such as Apple, Spotify, Google, Stitchers, and others. AFIRE is not engaged in providing tax, accounting, or legal advice. No content in this podcast is to be construed as a recommendation to buy or sell any asset. Some information included has been obtained from third-party sources considered to be reliable, though AFIRE is not responsible for guaranteeing the accuracy of third-party information. The opinions expressed are those of its respective contributors and sources, and do not necessarily reflect those of AFIRE.